The portfolio management process can be divided into 3 steps. I remember with PEF, planning step, execution step, and the feedback step. Let's get started with the planning step. The planning step involves understanding the client's needs and the preparation of the investment policy statement. For short, the investment policy statement is typically referred to as IPS. In the IPS, the objective of the client will have to be stated. The constraints will also have to be stated. So when it comes to the objective could be divided into 2. The risk, which we typically measure with standard deviation, the risk of the client to be stated, and the return, which we measure with mean. The return will also be stated. When it comes to the constraints, I remember with load squared, you have to discuss with the client as a client's portfolio manager or advisor the liquidity of the fund. A client would let you know how frequently they want fund. Is it every day? Is it every month? That means whatsoever they invested with you must be able to generate such income regularly. Still moving on, is such investment legal? What does the regulation say about the investment the client wants? Still moving on, uniqueness. Some clients will tell you that do not invest my fund in alcoholic companies, tobacco companies, firearm companies, and so on and so forth. All of these are all constraints. Still moving on constraints. Taxes. Some clients will tell you we want tax-free investments. Still moving on, time horizon. Some clients will let you know when they need their return on investment. Is it after 20 years? Is it after 5 years? And so on and so forth. The planning step in the investment process involves understanding the client's objectives. I'm sure we agree with that now. And the constraints in order to create the IPS. The IPS outlines the client's goals, what the client intends to achieve, the client's constraints, and a performance benchmark for evaluating results. To know how well you've performed, a benchmark will have been stated at the beginning when you were creating the IPS. The IPS should be reviewed regularly in order to align with any significant changes in the client's need or circumstances. Moving on to execution step. This step involves asset allocation, security analysis, and portfolio construction. Asset allocation involves evaluating risk and return characteristics of various asset classes. These various asset classes include equities, bonds, that's fixed income securities, and alternative investment. So that we are all on the same page, imagine I have 100 million US dollars to invest. Originally, I decided to invest 40% in equities, 30% in fixed income securities, that's bonds, and the remaining 30% in alternative investment. It's worth noting that equities are stocks. This was my original plan, but based on my economic forecast, I believe that equities will perform well in the coming year, so I decided to increase my allocation to equity. So I increased my allocation to equity from 40% to, let's say, 60%. So fixed income and AI, that's alternative investment, I reduced the allocation because I believe they won't perform so well in the coming year. So all of this basically has to do with asset allocation. It is worth noting that the risk and return characteristics of equities is entirely different from that of bonds, and the risk and return characteristics of bond is different from alternative investments. So still moving on, analysts can make their decisions of which asset classes to invest in or which individual stock to invest in based on two approaches. We have top-down approaches and bottom-up approaches. When it comes to top-down approaches, the focus is on macroeconomic trends, macroeconomic variables. These variables include GDP. They are variables that are beyond firms. So GDP, interest rates, inflation, and so on and so forth. Some analysts could make use of bottom-up approaches. Bottom-up approaches focuses on individual company specific factors. Some analysts could even make use of both approaches, which we could call hybrid approach. That's top-down approaches and bottom-up approaches. So they make use of these approaches in order to make informed investment choices. Security analysts combine these insights in order to evaluate individual securities within equities, individual securities within bonds, and even within alternative investments. You have decided to invest 60% in equities. Which equities should you go for? Which stocks should you invest in? It is based on intense analysis that will help the analyst arrive at the investment choices. So analysts evaluate individual securities and they also estimate cash flows relating to equities, relating to bonds, and also that of alternative investment. It's not just enough for you to estimate cash flows, you will also have to estimate the risk related to the cash flow, the risk that you might not attain the cash flow that you forecasted, and also the returns relating to different individual securities are also evaluated by analysts. Still on the execution step, portfolio manager will then gather securities in the portfolios in a way that they will achieve diversification benefits, and their aim to achieve diversification benefits will lead them to make decisions on asset classes, sector weightings, and the weightings of specific securities in their portfolio. Bear in mind that to achieve diversification benefits, the correlation between sectors, the correlation between different securities or different asset classes should be low. So finally, portfolio managers will have to coordinate with traders to execute their purchases in order to complete the portfolio construction phase. Moving on to the feedback step. This step involves portfolio monitoring and rebalancing. This step involves portfolio measurement and reporting. The feedback step helps portfolio manager to rebalance the portfolio in response to market changes or shifts in the client's circumstances. So that we are all on the same page. Imagine a client invested 100 million US dollars in your fund. 70% of it was invested in equity and 30% of the fund was in fixed income. However, the client's circumstances has changed. Originally, the client was a risk taker. For you to allocate so much funds into equity, bearing in mind that equity has more risk than fixed income, that means the client's risk objective was originally high. However, let's also imagine that the client's risk has reduced due to whatsoever reason. So if that is the case, you and your client agreed that the allocation to these two asset classes should now be equal. Originally, out of the 100 million, you invested 70 million in equity and 30 million to fixed income, making 100 million. But now that the risk has changed and we need to shed off some of the equity, that means we have to sell 20 million of equity to reduce this to 50 million, and the 20 million will now be added to fixed income to make this 50 million. By so doing, we would say we have rebalanced our portfolio. So we could rebalance portfolios based on market changes or even shift in client circumstances. Portfolio monitoring is of great importance. So portfolio monitoring and rebalancing are ongoing processes that adjust assets and security weightings as they drift from the target levels due to market movement. Performance evaluation involves whether the portfolio meets the client's objectives and the benchmark that was set at the onset of creating the IPS. If it doesn't meet the objective and benchmark, we might need to adjust the IPS accordingly.